Welcome back to the channel, guys, and sorry for the delay. I've been a little busy with some schoolwork and stuff like that, so I haven't been able to drop a video as frequently as I wanted to. And plus, I was doing a lot of research on, the GOAT of investing, Warren Buffett, the Oracle, and I just wanted to really come out with this series of videos, and I'll be coming out with more videos like this talking about different investors. But I really wanted to start off where I really learned a lot about investing, right? And I wanted to start off with Warren Buffett, right? And I've learned a lot, not just about investing, but just about, life and, being humble, right? And, because as great as investor he is, he's a very humble guy and he's very, generous with his wealth. And I inspire myself to be like this one day. And just wanted to really go in detail and like what did I learn from the Oracle, what did I learn from Warren Buffett. And these videos are not to say you should be like any individual investor, but I do believe that we should all take a little bit of pieces from what we learn from these great investors. And I'm going to basically talk about how how the Oracle basically helped me with my investing philosophy and my style of investing, right? right right so I love this quote, right? Building wealth through principles, not prediction, right? And I'll basically start off with a little story of the way I used to invest before I became the investor I am today. In the past, when I used to be investing, I used to really never know or understood what price was fair value, right? Or, because fair value is an opinion. But I never even knew how to come up with an opinion of what a fair value of a price was until I really started researching Warren Buffett. I used to just buy stocks randomly at random prices, try to use technical analysis and stuff like that. And, those stuff does work. I still use technical analysis in my investing, but it's not like the core of me coming to what I believe the price of the a stock is. So, I truly believe in learning fundamentals. And that's why in my first video I talked about, if you really want to get into investing, right, don't buy individual companies. Don't even buy the best companies like the Nvidias and the SpaceX and stuff like that. Don't buy nothing like that until you understand how do you value a company. But if you still want to participate in the market, get into the SPY, get into the Qs, and you'll be able to participate in the market. You'll be able to grow your money. And then when you understand how to value individual company, then you could take that money and you could use it to invest in individual companies, because they're a lot more riskier than investing in, the major indices. All right. So, this is just talking a little bit about, Warren Buffett when he took Berkshire Hathaway, when he really started it. But what I really like, right, is this quote right here. Price is what you pay, value is what you get, right? And sometimes it's really hard for us as retail investors, right, to really understand what that means, because you can't, like Warren Buffett was famously known for, he doesn't really care about what the stock market does, right? He doesn't care. He cares more about the cash flows of the company. And that really changed my perspective on investing. I look at investing, I don't really care about, of course I do kind of care about what the price does, because it's not like I could buy a whole company in the stock market. And because let's say, for example, if the stock is going down and I buy the whole company and I'm capturing the cash flow, and I believe the cash flow is, gonna outweigh the value, the overall value in the long term, that'd be awesome. But I can't think like that as an investor yet, because I don't have the ability to buy a whole company. But I do look at investing like when I buy a share of Microsoft or I buy a share of Meta, I am basically thinking I'm buying the whole company. And that's what I continue to do. And that's something I took away from the Oracle. That's what I took away from the GOAT. And another thing that I really captured from him was, this quote that he says, buy great businesses, not just cheap stocks, right? And what I understood from that was, a lot of times, we're buying a company because it's cheap, right? But like I always say, like in the market, something is cheap for a reason. Sometimes the market is wrong, right? Sometimes the market is wrong, but if it's cheap, that's why we have to do a lot of research. What I like about buying great businesses, right, is in my opinion like a Google, a Microsoft, Nvidia, all these great companies out there, right? In my opinion, these companies will never be at what you believe to be fair value, right? These companies are too great. Like the reason why these companies are so great, they trade at a premium, right? So when they do have those 20-30% pullbacks, right, that they're closer to where you believe fair value to be, I believe it's okay to buy, great companies at a higher price because great companies deserve to be at a higher price. You're not going to be able to buy a Microsoft. I think like Microsoft, I think it's at what, 2-3 trillion. Let's say for example, if you believe Microsoft to be 1.5 trillion, right? But it's trading at 2 trillion or close to 3. There's a reason why the market values it closer to 3 trillion because it deserves to be a premium. Microsoft is not just a regular business. Microsoft is a, you know, historical great business, a business that's most likely is going to be here for the next 100 years. It deserves to trade at a premium like Walmart. I think Walmart is overvalued in my opinion. However, I understand the the projections of their cash flow. Walmart most likely might be here for another 500 years, right? Walmart's a great company, right? And it's been around forever and it's going to continue still being around and it's going to continue to dominate and it's only going to continue to get better. So it deserves to trade at a higher valuation than a company that's just starting off, right? So that's why I really learned a lot from him. And other things that I learned from Warren Buffett was the circle of competence, right? Basically investing in companies that you understand. Like, don't invest in companies you don't understand. Like, that is, you know, so simple but difficult to understand. Like, sometimes you're buying, Nvidia, right? Let's for example, but you don't even know what a GPU is. You don't understand. You don't understand like what's the difference between like their competitors, right? And before I even make an investment into a company, I try to dive into the company and understand the products that they're selling, the competitors, the projections, and try to understand what's going on in the market that is causing them to have, this crazy, momentum, like what's going on in AI right now with the memory stocks, right? Maybe if you understood, because I didn't, maybe that's why I sold my position in MU a lot sooner than a lot of people, is because I didn't understand the need for memory in these AI models. Because it's not something I was, completely understanding of, right? Margin of safety, right? Margin of safety is kind of, it's kind of, in my opinion, is a little debatable, right? And it's debatable solely on the fact that, remember I told you great companies are never going to trade at their fair value. Like, they're never going to trade at their real fair value if they're not going out of business. Like a Google, a Microsoft, they're always going to be at a premium. They're always going to be at a premium. But if you could buy them closer to that fair value, I believe that's that discount. When you have other companies that, for example, United Health, in my opinion, went way below its fair value, right? I believe it was it's still off in my opinion. But when I bought it, I think it was like 40%, off of what I believe the company to be valued at. And I bought it. And, I was able to make a really nice return, I think 35% on that stock. And I feel like I really had a, circle of competence. I had friends who were in the medical field, and I understood insurance, and I felt really comfortable with making that investment, right? So I saw that 40%, as a margin, like off of my fair value, as a great margin of safety and the economic moat, right? And that's just basically a company that just has a great advantage. Like for example, like Nvidia. Nvidia has a crazy moat right now. They basically dominate the market with their GPUs, and not just that their GPUs are just so much better than everybody else. It's just, there is like when you get Nvidia's type, when you get like stuff from Nvidia, it's like the whole package, right? It's not just the GPU. It's like a bunch of other stuff that it connects into your system, and now even if other players come into the game, it's still very difficult for you to switch from Nvidia because everything you have is kind of works well with Nvidia, and it would cost you more money to switch out than to just stay with them. So that's like a great example. Like, Microsoft Office is a great example. There's many companies that use their products, and it would cost them more money to leave and to switch over, because then you got to train all your people when everybody's pretty much well trained in Microsoft Office. Walmart, stuff like that. Like, that's what I kind of like mode is. And so like from my investing, right, what I learned from Warren Buffett, right, was he taught me like using a discounted cash flow model, right? Using a discounted cash flow model, the marginal safety, circle of competence, and the mode of a company. But what I really like, that discounted cash flow really changed my way of investing, because it made me understand that like I said at the beginning of the video, like I used to just buy a company, really not understanding what is fair value, right? What is fair value for a company, right? And I loved, because this kind of cash flow taught me on how the market really operates, right? The market usually look at companies, right? They're looking at a company like they're gonna grow forever and make money forever until they don't. That's my opinion. But that's the way I look at the market too. I look at it, when I'm doing my discounted cash flow, I'm projecting the free cash flow of this company to continue growing forever, and that will give you a price, because that's, in my opinion, how you should value some companies. Not all companies you can use a discounted cash flow, but the majority of companies you can use it, because a company should be valued based off of the cash that it generates. It shouldn't be valued, in my opinion, like you're never gonna come, like if you're gonna buy a company, you're not gonna say, hey, I'll pay you 20 times revenue for your company. You're not gonna use metrics like that. It's that'd be kind of weird. You wanna buy a company based off of how much cash the company makes. But like I was saying, I got off a topic, but the way I used what he taught me is like I do use the discounted cash flow model. However, that's not the only thing I use, but that I learned from him, right? I'm gonna look at the discounted cash flow model. I'm gonna use technical analysis. I'm gonna use indicators, right? I'm gonna use stats. I'm gonna use chart patterns. Like, I'm gonna use all of that when I take into consideration buying a company. My circle of competence, my margin of safety, the mode of the company, the projections. Like, I take a lot of stuff into consideration when I'm going to make that purchase, right? So I want you guys to take this from this video. You don't have to take one thing. Like, I'm not going to tell you like using a discounted cash flow is the only way you should value companies, right? Because price actions matters. What's happening, like economic factors matter. Indicators matter. Like, don't let anybody tell you like indicators don't make money. Like, they do, right? It just depends how you choose to use it, right? It just depends how you choose to use it. So I'll leave this here, guys. That is basically what I learned from Warren Buffett. I wanted to share those things with you. I'll be coming out with more videos talking about more investors and what can we take from them to make our investing more useful for us, right? So like, I believe anybody, if you want to take anything from Warren Buffett, these three things are the most important thing. Like, but when you're using your margin of safety, you need to do a discounted cash flow model. You need to understand, right? What is your project? Like, if a company's, let's say for example, if you believe the company's valued at $400, if it's at 395, is that worth it? Is it worth you deploying your capital to capture $5 a share? Like, I use the example is United Health. United Health, in my opinion, was 40% off of what I believe the company to be, and I thought that was extremely attractive, and I bought it, and I made a good amount of money on it, right? So I think, like, if you're gonna take anything from from Warren Buffett, the oracle, the goat of investing, who averaged, I think, is 19.6% throughout his 40-year career investing. And if you guys, take your whatever whatever money you have aside to invest, you know, multiply that, sorry, not multiply it, use a compounding calculator and give yourself a 20% discount rate for 40 years and see where your net worth would be. Like he started with $1 million and his net worth is now at 144 billion, I believe it is. And it's super impressive, guys. And I think one of the reasons why I'm really I'm making this video kind of long, but sorry, but like one of the reasons I really love Warren Buffett is because what he did, I think anybody could do. I think anybody could do and can invest just like him if you have patience. And I think that's one of the things, I should have put that in the slides, but I think his edge in the market was his patience. But okay, I'm gonna leave it here, guys. I don't want to make this video too long, but thank you for watching. Subscribe and like, and I'll catch you guys in the next one.